Right, the numbers have crept up, so I think we'll make a start. So good morning, everybody, and welcome to Casa Humphreys and to the BHP review of the autumn budget and the spending review 2021. We were pretty close actually to holding this as a face-to-face event, which is normally what we would do, but in the end we decided to do it as one final Zoom webinar. So I'm grateful for you all logging on early. Usual format, Katie Hall from our business development team is in the background to make sure I'm kept on the straight and narrow. There's obviously the ability to post comments or to post question and answers. If I'm switched on enough, then I'll hopefully pick them up as we go through the presentation, but if not, then I'll get to them at the end. And then at the end, there is a feedback form, which hopefully you'll tell us what you like and don't like about the presentations, what perhaps you want to see in the future, and whether there's anything else that we can help you with. I'm going to start today's presentation by actually a confession. And that confession is that I wasn't around on budget day, October the 27th. Now, in returning to an autumn statement, our Chancellor has quite clearly taken the decision that it needs to fall within half-term week. Now, whether that's because it's some devious plan on his part to avoid paying the inflated prices of flights and holidays when all the kids are off, I don't know. But in reality, when the Chancellor stepped up at 12:30ish on October the 27th, this is where I was, which is a very nice little golf course, actually. Sorens de la Torre on the Costa Blanca. This is a tricky little par 3, the 7th. Usually I'm in that water on the left, but actually on this budget day, I made it to the green. Nice little 2 putts, regulation par, and I wandered off into the distance and parked up and thought, well, I'll listen to the budget. And it's an interesting dynamic watching the budget from somewhere else, because in the first instance, actually, you could be totally oblivious to it. You could go through life having no knowledge whatsoever in another jurisdiction that we have had a budget or a review or a spending announcement. Actually, you could be totally oblivious to it. And then the middle ground, I suppose, is that the headlines are always about deferral of fuel levies or national minimum wage or national living wage. And then inevitably, by how much is going on a pint of beer or cider or whatever it is, those are the mainstream headlines. But I think for me, what I did, I parked up, logged on to the BBC, which gave me real insight into what was happening live. And then, to be fair, I logged on to the BHP updates. And I'm very grateful for the rest of the BHP tax team for picking up the slack whilst I was away and giving me a chance to have some insight into what was happening in the budget from a far away. What was interesting to me, actually, and I was surprised, is that this is actually Rishi Sunak's 3rd budget. Doesn't time fly when you're having fun or you've got a global pandemic in the background? His first budget was actually in March 2020, which, if you recall, he actually only had 28 days preparation for, following Sajid Javid's resignation. And at that time was quite clearly a split budget where there was an element of normal business, but quite clearly at that stage, there was an element of starting to worry about the impact of COVID-19. And it really took me back to, actually, that probably was the last large-scale seminar that I did face-to-face. And I'm pretty sure that Thursday was the last chance that many of us got together before going into lockdown, either on that Friday or that Monday. So I think a lot of us sort of look back to that and think, well, actually, that was a sea change in the world. March 2021, his second budget, was a budget wholly influenced by the global pandemic. The terminology around it was getting the job done, leaving nobody standing, making sure that the last man was always looked after, and doing whatever it took to make sure that we got through a very difficult period. And now we're returning not to a March budget, to the original format, which was an autumn statement in October 2021, with a direct link to the 3-year spending review. And it always seemed to make sense that you would link your budget decisions to the actual income and expenditure of government. And in doing it, you would announce it at a time that people have the chance to understand it, to take action one way or the other, and to know that from the start of the next tax year, they would have certainty as to what their tax position would look like. And it's probably the first time that we see our Chancellor coming out and showing his true colours and having to sort of expand his toolkit and his remit. And the terminology of this budget is protecting the jobs and livelihoods of the British people, building back better, and this huge ambition to level up and reduce the regional inequality. for me, sitting in a sort of kitchen in Sheffield, sort of welcome all of that. But I suppose we need to understand the basis of the economy before we can really interpret what Rishi said. And this is what he told us about UK PLC. And one of the key things is that the growth forecast has actually been revised upwards by the OBR from 4% to 6.5% in 2021, to 6% in 2022, and then dropping back down to 2.1% in 2023, but still much stronger than we anticipated. And the definition, or the thing they talk about now, is COVID scarring. You know, how far back behind are we as a result of COVID? And that's now being predicted at being 2% rather than the original estimate of 3%. So we're sort of pulling that back slightly. Unemployment expected to peak at 5.2%, predicted to reduce actually back down to 4.2%. Now, actually, around about 5% was the original target prior to a pandemic. So to think that we're going back to 4.2% is pretty good, and shows that actually the economy is creating job opportunities and the number that are unemployed is relatively low. And the stance from the government is quite clearly that the coronavirus job retention scheme has limited the labour market scarring. Now, for somebody who has been involved in doing furlough grant claims since April 2020, I'm still scarred. And I'm glad to see the back of it. I understand its reasons, and I understand that it developed some great relief for businesses at a time when they really needed it. But in terms of the pressures on businesses and accounts to deal with it and the complexities of it, I'm glad to see the back of it. The biggest worry, I think, actually at the moment is the inflationary pressure within the economy. Inflation in September 2021 is 3.1%, as it is anticipated to rise to an average of about 4% over the next year. Largely, we're told because of supply chain issues and the increase in energy costs. And certainly from our perspective, we're seeing significant wage inflation in the marketplace. The inference from the Chancellor is that this is temporary. It's just taking us time to sort it out. And he still believes that the target to be set for inflation should be the 2%. So quite clearly their view is that the pressures are there, but they will dissipate over time. The other side of that is obviously government borrowing. Government borrowing is an immense £319.9 billion, the highest level since World War II, and 96.6% of GDP. But I suppose in the background, the Chancellor's view is always that, well, I'm okay to borrow that amount of money because actually the cost of that borrowing is currently, relatively low. And this is an interesting debate, and actually the Bank of England at a Monetary Policy Committee are meeting later today, and it will be interesting to see what their call is on an immediate interest rate increase, or whether they just predict that they will happen. But the expectation is that interest rates over the next year or so will increase to possibly 3.5%. And that's as a means of trying to get control on the inflationary pressures. And I suppose there's a balance in there. The debt burden is most probably, effectively shown by this chart produced by the OBR, which shows the inference that we're heading up to 100% of UK debt to GDP. It's at similar levels to the 1960s. So, it shows that the burden is increasing. The peaks before are largely around sort of World War I and World War II. So it shows that we are quite clearly highly leveraged, and we're okay with that at the moment because interest rates are low. And I suppose that's the overriding picture that came to me from the budget speech, which is that we are a significantly highly leveraged business with an expectation that the cost of that debt is likely to increase. An increase at a time where actually there's also increasing global uncertainty as to what the world looks like. What does the supply chain look like? How long will it take for containers to be in the right place at the right time? How do we rejig all that around? And I suppose we're also still unsure about what the outcome of COVID-19 is. The figures show that we're still impacted significantly by that. We're just about to head into a winter flu period. The pressure on the NHS is considered to be significant. We're still worrying about whether we're going into another lockdown. And the overriding principle is that public finances at the moment are twice as sensitive to changes in interest rates as they were before the pandemic. Their sensitivity is sort of high at the moment. And the figures are that 1 percentage point increase in inflation and interest rates would actually cost us directly £23 billion. So it doesn't need to move much before the cost of that £319 billion becomes significantly expensive. And you only have to look at the impact on the pigs, Portugal, Italy, Greece, Spain at the time of the economic recession to see how increases in debt servicing costs and confidence around that can actually cause problems within an economy. Around all of this, actually, the picture is pretty strong. Growth is better than anticipated, and the OBR has confirmed that. The tax take is higher. The government has confirmed that the tax take, certainly in July, was significantly higher than anticipated. So growth, stronger tax proceeds, what do you do with that? And in a normal world, you would be thinking, well, what do I do? Well, I could pay down my mortgage or pay down the debt, or shall I spend it? And here we have a Chancellor saying, well, I'm not going to pay down the debt. I'm going to rely on growth, actually, to resolve the debt issue. And I'm going to spend, the additional proceed funds that I've got. And that it struck a chord with me. I'm just about old enough to have been around at the time, but in 1961, Viv Nicholson won the pools. I mean, who remembers the pools? And won £153,000, which is equivalent to about £3.5 million today. And famously said, well, I'm going to spend. And she did. And at the end of it, but she's no longer with us, she had nothing. So there is a moral perhaps to that. And the scale of all this became clear as I'm sat under the tree on my golf course, because all the things that came through were, £150 billion additional spend within the Treasury. By 2024-25, the largest real-term increase in overall departmental spending this century. And it kept coming through in terms of Scottish Government, 4.6 billion, Welsh Government, 2.5 billion, Northern Ireland, 1.6 billion, cause science funding, 5.9 billion, courts, prisons, probation schemes, 2.2 billion. It's like monopoly money, it's get throwing out there. And it just went on and on and on, and all you could see is spend. And I think the Guardian actually did an article a couple of days ago where they sort of tried to pull it all together and say, well, if you were to do a profit and loss account for what the Chancellor's got in mind, what does it look like? Well, it looks like £1,045 billion worth of total increased spending against £962 billion of revenue. And at that point, you're starting to look like a Premiership football club who's actually spending more than you ever get in as revenue. And the figures are startling. But we believe that it's sustainable, or our Chancellor believes that it's sustainable. When you're looking at increased spending on health and social care of £178.5 billion, generally we're happy to accept that, but there needs to be at some point some squaring up. And I'm not wholly convinced at the moment that growth is going to do that. And I'll come back to that at the end. But on the slide, I've tried to pull out the scale of these figures, where they're going, and a sort of a leap of faith that in giving this money to these departments, they're going to spend it in a way that's going to have the impact on the economy and us as individuals as we would want it to. And there was a lot of doubt around that. I'm quite a cynic at the time. The other issue with this budget is actually a lot of it was sort of predetermined, preordained, leaked. We'll call it what you will, but we knew about a lot of it. And the Chancellor was actually criticised on the day for the fact that most of what he was going to tell us was out there already, and he'd not told MPs about it. There was good news in there, and hopefully I'm going to pull out some of that good news so you can see that there's elements of stuff in there that's good, and then I'll go back to reflect on the bad news that's behind it. In terms of business rates reform, this is extremely good news for the high street, but it's still not the root and branch review that people were demanding, the total overhaul of the business rate system. It resulted in a consultation that was originally published in March 2021, with a final report being issued on Budget Day, 27th of October. And it provides for a new temporary business rates relief for eligible retail, hospitality and leisure property for 2022-2023. Which means over 90% of retail, hospitality and leisure businesses will receive at least 50% off their rates bill in 2022-23, but up to a maximum of £110,000. Now, I'm a director of a hospitality leisure business, and looking down my profit and loss account for the last 18 months, the most significant cost that I could have been exposed to would have been my rates bill. So to see that relieved automatically without needing to apply for it, and the bill to be reduced has been of immense benefit. So I think this quite clearly is has got to be welcomed. Around that, there is the transitional relief for small and medium-sized businesses and the support for the supporting small business scheme that's still there. So, there is significant relief in terms of business rates for businesses over the next year or so. Other issues around this is that the multiplier, which originally increases, is going to be frozen until 2023 and frozen at 49.9p for small businesses and 51.2 pence as a normal standard multiplier. And then valuations are going to move to a 3-year cycle rather than a 5-year cycle to try and move some of the inequalities on the valuation system out. So quite clearly, lots of stuff around business rates reform. And then I suppose the final bit on business rates is that from 2023, where you spend money on improving your property, and it's sort of a definition of eligible expenditure around that, then the impact of that on your rateable value will be fully relieved, so you won't pay additional rates. So seeing some sensible stuff in there, but probably doesn't take it as far as we would have liked. Some other sensible stuff is around the annual investment allowance. Now, this has moved up and down over the years, and was increased or extended from £200,000 up to £1 million, and was due to fall back to £200,000 at the end of this year, end of December 2021. The annual investment allowance is now going to be retained £1 million until the 31st of March 2023, and is sensible because it aligns this temporary AIA with the super deduction that was announced in the last budget. So I suppose the principle is that in terms of qualifying in capital expenditure, you can spend up to £1 million and you will obtain 100% corporation tax relief for that expenditure. However, up until March 2023, you can, by planning your capital expenditure accordingly, actually get 130% relief of whatever you spend without any cap. So significantly beneficial for businesses that have cash on the balance sheet that they want to invest in plant and machinery, and the carrot is quite clearly there to try and make you spend it. So the super deduction is 130% on new expenditure that would normally qualify for what we would call the main pool, the 18% relief, main rated writing down allowance, and a first year allowance of 50% on new expenditure that would normally qualify for the special rate pool, the 6% rate writing down allowance. So make use of that. It quite clearly will support your investment decisions with certainty up until March 2023. More of this later, because whilst this is the carrot, there is a stick that's coming. Research and development, probably one of the most attractive ways of improving your cash flow, in that where you incur qualifying research and development expenditure, you can obtain immediate repayments of tax to you without clawback. And it quite clearly is here to stay. One of the announcements was in the budget that the government expects to spend an additional 22.9 billion on R&D, and they want to expand its remit and what qualifies. And in doing that, they've sort of understood that modern research methods include data costs, cloud costs, and that really they should be included within the definition of qualifying expenditure. So it seems to me that makes common sense. They want to try and focus R&D and innovation within the UK. So they're trying to capture the benefits of that R&D by funding, refocusing the support to innovation that's undertaken within the UK rather than around the world. And generally, they want to make sure that the relief when it's given and the tax repayments that are given for the right reasons, for the right sort of innovation. So they're trying to target abuse and improve the compliance around it. All of this is framed within an ongoing consultation. The outcome of that will see changes effective from April 2023. As a practitioner who's been involved in R&D claims right from the start, I think the targeting of the abuse is certainly welcome, because there are, how would I describe it? Being quite strongly, describing quite strongly, charlatans out there who will tell you that they'll get every single penny back based on the fact that they imagine that you've undertaken some qualifying activity. And some of those claims have gone through, but it quite clearly is not good for the profession. It's not good for how the relief works. And, we need to ring fence it to really understanding, what is qualifying expenditure, how is it relieved, and how does it generate innovation and R&D within the UK. I think for me, I would hope that the outcome of some of these consultations is the ability actually to increase the rates of relief that are available. Obviously, we have the RDEC scheme for large businesses and we have the SME scheme. One's significantly more beneficial than the other, but there's no reason why those rates couldn't be increased, particularly now we've had Brexit. And then the other dynamic is that we're going to come back to talk about corporation tax in a bit. And the rate of corporation tax is going to increase from 19% to 25%. And so it might be that the dynamic is that instead of giving away your R&D for an effective tax claim of about 10 to 11% under the RDEC scheme, you might want to carry it forward and offset it against profits at 25%. So you'll really need to model how and when you claim your relief. But certainly happy that it's still around, happy that government's still consulting on it and targeting it, and more than happy that the sort of charlatans around the edges are being pushed out of the market. I suppose the other bit about this budget is that no news is good news, and this brings me nicely to capital gains tax. The annual CGT allowances are frozen at 12,300 until 2025-2026, which does mean there's an element of stealth tax within that. In that, inflation will mean that more people will realise gains that are greater than 12,300. But around all of this, there was the incredible rumour mill that sort of suggested that rates of CGT were going to be aligned with income tax rates, were going to be increased. This was supported actually by some of the work of the Office of Tax Simplification, and it ran. And one of the things that was silent in this budget was anything to do with capital gains tax. So business asset disposal relief, or entrepreneurs relief, as we probably more better remember it, gives us a chance to make a gain of up to £1 million at 10%. Which is very beneficial. The rates generally are confirmed as being either 10% or 20%. Or 18 and 28% if it's UK, if it's residential property. I think that that certainty is welcome, but for me, I'm cynically sort of viewing that the rumour mill has actually generated quite a lot of transactions which otherwise wouldn't have happened. So in the run up to March 2021, certainly our corporate finance team were bombed out, and lawyers were as well, trying to complete deals before the budget in expectation that CGT rates might increase. And certainly I think that also happened in October, where I saw quite a lot of Twitter posts and LinkedIn posts saying successful business disposals had taken place, driven by the risk or the worry that capital gains tax rates would increase. And it might well be that we end up doing exactly the same in March 2022 if there is to be some sort of budget announcement in that pace. And I think the issue is that you can always avoid capital gains tax by selling nothing. So you can increase the rate to 50%, but if nobody sells anything, you don't make any money. Whereas if you've got this rumour mill that sort of says, well, actually it might increase, so you can only protect your position by selling, then actually it generates transactions might not otherwise be the case. The other good news about CGT is that there is a requirement to deliver a CGT return and make a payment on account of CGT to HMRC within 30 days of a transaction. That's for UK residents disposing of UK residential property, and also to disposals of UK land and property by non-residents, any disposal. So pretty onerous 30 days. And I think the government's reflected on that and said, well, actually, will it work for disposals after the 27th of October 2021? We'll extend that to 60 days, just to give you a bit more time to understand what the CGT calculation looks like, to determine what the return looks like, and to make the payment on account. So a sensible approach. The other side of sort of capital taxes, and again, it's a no news is good news point, is on the inheritance tax side. We already sort of knew that the nil rate band was going to be frozen at 325,000 until April 2026, and similarly, the residential nil rate band frozen at 175% until 5th of April 2026. So again, stealth taxes will see additional IHT rates just because the value of those estates has increased above those limits. But there are no potential changes or reforms, and this is despite the all-party parliamentary group meeting to say, well, actually, they recommended that there should be a root and branch review of IHT, that there should be a consideration of how it interacted with capital gains tax and the tax-free uplift on death, and the fact that it seems a bit bizarre that you can give anything away and live for 7 years and then pay inheritance tax at 40% on whatever's left. So there was a whole sort of model around that suggested that actually the clock might disappear, the 7-year clock, and that you might pay tax at a IHT rate on potentially exempt transfers, or on transfers that are currently potentially exempt. That's not turned up, nor any sort of potential reduction that could have resulted in final IHT on estates when people passed away. And then the principal bit of planning that we do quite a lot around at the moment is whether assets qualify for business property relief and agricultural property relief, and the nature of how those assets are held to ensure that they do. And within the all-party parliamentary report, there was certainly some pressure to reform the basis of those reliefs to make them clearer and possibly to reduce them from the current 100%, which is extremely beneficial. But again, none of that, silence is golden, so nothing of that in this budget, but it's still in the background bubbling away. Okay, let's get to some bad news, which quite clearly is the stick that follows on from the carrot, the annual investment allowance and the super deduction. And this is the announcement, which we already knew, that corporation tax is going to increase to 25% for companies with profits over £250,000 from the 1st of April 2023. If you are, as an error in the slide there, but it's 19% for profits up to 50,000. And then if your profits are over 250,000, you've got the 25%. So there's a real demarcation between sort of small and large businesses, which I've always said is a good thing, because it reduces the burden on smaller businesses, which are probably struggling quite a lot of the red tape around corporation tax. But it does mean that in that middle sort of the 50,000 to 250,000, there is a catch-up. And it's the marginal rate, and the marginal rate is always more than the main rate, the 25%, because you need to catch up and get to it, so that at the point that you have got £250,000 of the profits, you're actually paying tax fully at the 25% rate. So that's a pretty significant hike. And within that, at the moment, the associated company rules are really looking more directly at anything that's a 51% subsidiary. And I think the intention is that the rules will, from 1st of April 2023, return to old world, which was where an associated company was generally anything that was within common control. And then we had all sort of arguments with the revenue about whether that common control was sufficient to enable to have commercial interdependence between the companies. But it's the expectation is that possibly the number of associated companies within your corporation tax returns will increase, which will mean that the bands will be reduced. And in reducing the bands, it's more likely that you're going to fall in that marginal relief point, marginal rate band. So you need to plan around that. And it'll be interesting to get back to all the sort of questions about, do we revisit our management charges? Where are profits being realised? How do we charge between different group companies? And I suppose it's back to the good old days, which seems a bit strange. One of the interesting things that might come out of this is that the general sort of direction on travel on remuneration planning has been to take a sort of minimum salary that covers your personal allowance and meets your national insurance requirements. So you've got a big tick in the box for your state pension. Company contributions to pension have always then been the next stage, because they're not taxable on you as an individual, but they're tax deductible in the company, so that sort of works. And then anything above that, generally we've said, well, take a dividend out, because that's the cheapest overall way of withdrawing your money. And I think we really need to start doing the analysis on is that direction of travel changed totally? Because actually a payment of remuneration by way of salary now obtains corporation tax relief at a much higher rate. So when you look at the effective rates of tax, does it now swing it to the point where actually salaries and bonuses become better than dividends? And it will be on an individual by individual basis. You'll need to do the mathematics, and there's all sorts of models and spreadsheets that we've put together that we can help you with to work that through. But quite clearly, that is the stick that follows on from the carrot with the super deduction. The other stick that's around is, and bad news, is in relation to income tax. Okay, so headline rates of income tax are still the same. That's what we're being told. The personal allowance is frozen at 12,570 until 2025-26. The basic rate band is frozen at 37,700 until the same date. So effectively, you're again in a position where just the wages inflation and the movement of time will mean that more people are paying tax at the higher rate. So the tax take will increase as a result of the stealth tax. And I don't think the Chancellor's expectation is that that will help him to fill his coffers. The substantive change, and this was announced back in September, is the increase in the rates of tax on dividends from 6th of April 2022. In that at the moment it's 7.5% for basic rate taxpayers. That's going to become 8.75. Similar increases at all the levels for higher rate taxpayers and additional rate taxpayers. So the rate of tax that you will pay on dividend income will increase proportionately from 6th of April 2022. If that's the case, then you need to consider your dividend policy. If you're following a fairly basic dividend model where you're taking remuneration by way of dividend, it's unlikely that advancing dividends is going to save you enough tax to sort of counter the cash flow disadvantage of paying your tax a bit earlier. But again, you need to do the mathematics on that. If you are intending some sort of special large dividend, then there's certainly some merit in doing that before 6th of April 2022. Because in doing that, you will pay tax at 38.1%, let's say, instead of 39.35%, which if it's on a large enough figure, will make it worthwhile. No impact on dividends received on shares held in ISAs or pension funds. They're not taxable on those anyway. But quite clearly, there is an increase in the tax bill for people that receive their value by way of dividend. The nil rate amount of dividends you can receive is still £2,000. And I think the model in the government's mind is still that covers most people. You know, most people, individual mere mortals, investment portfolios generate income of about that level. So actually an increase in the dividend tax, they're sort of saying, well, actually the people with larger investment portfolios are the ones that suffer. On the sort of train of thought on that and the mirror of that is the increase in national insurance for 2022-2023, which is really to fund a permanent increase in health and social care expenditure. So the media message around this seems to be sort of, well, actually, we need to increase expenditure and support to the NHS to deal with COVID, to deal with the impact of delays in other support within the NHS. And the way to do this is to have a sort of temporary increase in national insurance to fund it. So it's a UK-wide 1.25% increase, ring fence for health and social care. It starts immediately on the basis that it's an increase in national insurance, all levels, so it's met by employers and employees. It then disappears in 2023 to be replaced by the health and social care levy, same figures. Again, the principle is it's a fund directly ring fenced, so that 1.25 goes directly to the NHS and social care. So seems to sort of have some social CSR responsibility background to it, which I can get the basis of. It doesn't apply to those in receipt of property income. So if you're a property holder and you're receiving rental income, that's great. No increase in your NI charge. It does apply, however, to those above the state pension age who are still in employment. So that's the sort of health and social care levy. So actually, you know, at that point, you will be paying more tax by any other name. So just have a think about it. But on the face of it, seems good stuff. Okay, how do I explain this one? Well, accounting a period is not aligned to tax years. I mean, it's always been within the remit of an Englishman and his castle to determine what his own year end is. So if you want it to be December, it can be December. If you want it to be June, it can be June. That's fine. It can be determined by the ins and outs of your business, and it's been under your control. It's always been, I think, a long-term aim of HMRC to tie accounting period directly to tax years. In their mind, it seems simple. If you are an unincorporated business, why wouldn't you have an accounting period that ends on the 31st of March or 5th of April? Because it makes it easier to square up your tax return and to see what the taxable profits are. And this long-term aim goes back to all the way back to self-assessment and the current year base of assessment back in 1999 and was muted at that point. And since then, we've had these stupid rules about how do you calculate profits when you start business, how do you calculate profits when you cease business, and in the middle you've got this overlap relief that you might carry forward for years until you get relief for it at the end. So from 2024, the expectation and the changes that, you know, effectively your accounting period should be aligned to the tax year. If you decide that that's not the case, then you can have your own year end and still have your own castle, but we'll simply time a portion of the profit so they do tie in with the tax year. There'll be a transitional year in 2023-2024, and the new rules will come into effect from 6th of April 2024. The feeling is that will accelerate when business profits are taxed, But as where this has happened in previous cases, for example, on changing to accounting policies on work in progress, the ability has been there to ease the cash flow impact by spreading the additional tax charge over a number of years. The broad brush behind this is that 93% of sole traders and 67% of trading partnerships already draw up their accounts to the 31st of March or 5th of April. So from a government perspective, actually they're saying, well, there's not a huge amount of people this is going to impact. But I think if you do have a year end that's different to the 31st of March or the 5th of April, then you need to work through the rules and see what the potential impact is, and how you're going to calculate taxable profits, and what does your tax charge look like and where will it arise? And then to consider from that, what is the transitional basis that gives you relief and how do you spread that? Yeah, I suppose the way that the Chancellor describes lots of things, and whether it's now in the budget or whether it's in previous announcements, it's always that money is being raised for a specific reason. So what they're now talking about is the introduction of a property developer tax, which is part of the government's building safety package to bring to an end unsafe cladding and the impact of Grenfell. So from the 1st of April 2022, there will be a 4% tax charge on profits. It applies to companies with profits arising from UK residential property, but only if the group has profits of more than £25 million per year. So I think from their perspective, they're looking at, headline large property developers who are generating significant profits from residential property. £25 million allowance is spread across the group. So it'll be divided by the number of companies within the group. And there will be some rules around the deductibility of finance costs against those profits. Because generally those sort of groups tend to be highly geared and have significant finance costs going through as they develop that residential property. Again, from a CSR point of view, it seems to make sense. Somebody's got to fund the work that's been undertaken on recladding lots of buildings around the UK. And if this is one way of directly funding that, then that's a good thing. The government view is that it needs to be a pot of about £5 billion. And they're modelling that the 4% tax charge on profits will flow to that £5 billion. Whether that will be the case, obviously time will tell. We come quite nicely at the end of that into what I'm going to call the bucket, which is everything else that is in the budget speech. And it made me laugh, actually. As I say, I wasn't there on budget day, but anecdotally, I know the tax team was sat in our boardroom going through it, and the head is in the hand saying, well, he spent so much on healthcare, and he spent so much on prisons, and he spent so much on schools, and and where's all the tax bits that he's going to raise it? And actually there were very, very little, because as I say, the expectation is going to come from a growth and additional revenues that will just flow naturally. So in terms of tax generally, it's probably one of the lightest budgets that's been around for a while. There is a consultation on a possible online sales tax, which if introduced would raise revenue to fund directly further business rate reductions. I suppose they're saying, well, if you're selling online, then you're not incurring business rates. So those that are maintaining a high street presence should have some sort of subsidy one against the other. I'm a bit dubious about all these sort of taxes, because I read an article that said that the Google tax, the diverted profit tax that George Osborne introduced in relation to online businesses generally, has raised nothing. And this one again might possibly be pie in the sky. There's an anti-money laundering levy from 1st of April 2022, which will see direct levies of between 10, 15, 20,000 pounds on businesses to support action against criminals and money launderers. So that's fine. VAT registration, deregistration thresholds frozen again until 31st of March 2024. I think we knew that anyway. Very, very little otherwise around the VAT position. Making tax digital for income tax self-assessment deferred until 6th of April 2024, and for partnerships until 6th of April 2025. I think it's definitely coming, but they keep pushing it on a little bit, which is good news, which will give us more time to really understand the impact on quarterly reporting. What does the tax return look like? How are we able to report it on behalf of taxpayers in real time? So all that sort of stuff is coming through, and it's just being pushed on. And I suppose, given that we've had a global pandemic, it probably is helpful. The charity side of our business, we're extremely pleased with this last one, which is that the museum and galleries exhibition tax relief and the orchestra tax relief and the theatre tax relief were all extended until 31st of March 2024, with an immediate increase in the rates for that period, and then it would take back off. And the whole idea of this is, well, it's the Andrew Lloyd Webber effect, is that there's significant concern about how do we encourage theatres, exhibitions, shows to return to some sort of question of normality at a time when we're still under pressure from COVID, and the only way to do that is to provide some direct support. So this is really trying to give them some enhanced support to do that, and the rates of relief are, you know, pretty high, around the 40% mark now, so that's quite good. But which sort of brings me finally to why I think the budget was light on tax, in that you know, again, these are figures from the Office of Budget Responsibility, and it shows that the UK tax burden is expected to be about 35% by 2025-26, which is as high as the 1960s. And you know, for a Chancellor of a Conservative government that generally has been a low tax government, a low tax party, I think they are under pressure that at some point they will start to have to address this tax burden and to reduce tax rates or give additional tax reliefs. And you know, the cynic in me says that's probably going to be heading towards some sort of election as we move towards that, which I suppose brings me nicely to the end of where I go with this, in that, you know, I think there are two betting slips here. You know, one is one I'm putting my money on, which is the Rishi Sunak to be the next Prime Minister. I mean, I think the odds are closing in on that, and currently it's about 11-4. So, you know, I put 10 of my money on that. I think the wider one is something that somebody else, Rishi Sunak, is putting all our money on, which is, you know, an additional £1 trillion of expenditure, on the basis, the commitment that economic growth will come in to solve the UK debt problems, and in the meantime, the cost of debt won't increase too much, and that seems to me a significant gamble that you know, time will tell, but it's a pretty significant gamble, which sort of leads me to an overview about Rishi Sunak. I mean, I do like the guy. He's obviously not a comedian, because his budget speeches are quite dry and some of his jokes are pretty poor. But on the left-hand side is something that was tweeted by Simon Walker from the Treasury at the time of just before the budget, which suggests that the common man, Rishi Sunak, you know, has a can of Sprite and a Twix before he delivers his budget, which is, you know, because he hasn't got a chance to do anything else, he's running around, and that's the fuel of the common man. And yet on the right hand side, I see an individual who's wearing something called sliders, and not only is he wearing sliders, they're sliders from a business called Palm Angel, which cost about £100, and he's wearing socks with sliders. Now I'm an old style flip-flop man, and flip-flops cost a tenner. So, you know, are we actually being driven by the common man who understand where we're coming from on our concerns and the risk, and do we buy into that, and are we going to put our tenner on him as a Prime Minister, or is he reverting back to his sort of hedge fund background, which is about entrepreneurial gambling, leveraging, in the hope that the result is better for all of us? And for me, I don't know, but the Palm Angel bit does worry me slightly. And at that point, that has been a real rattle through all of that. I don't think I missed anything in terms of what was in the budget. More than happy to deal with any questions. And as I say, the BHP team are around if you ever need support or just want to talk some of these things through. So I'll just look at whether we've got anything in the chat. No, nothing in the chat, not Q&A. Brilliant. Top stuff. Okay, well, as always, you know, thank you for joining us. You know, the support is appreciated, and, you know, I hope that you found today, you know, entertaining, but also informative, and it gives you a real feel about, you know, what the last budget looks like. And I think if there are no questions, then I will leave you. And what I will say is that I look forward to actually seeing you all face to face at some point in the future. It's certainly much easier than doing it by Zoom, and enjoy the rest of your day. Thank you.